All right, today is Fed Day. It also happens to be a casual day, and just a reminder of who you want to root for, wearing the cap of the team that you want to be rooting for here on Saturday afternoon at 3:30 Eastern Time. See if we can keep the good vibes going here. But today was Fed Day as well, and we're going to break down in today's market outlook video the market reaction to this meeting. And now what the technicals tell us going forward from here. It's in terms of the train leaving the station and this intermediate run now entrenched, and how to take advantage of high probability technical setups with high probability strategies. And we're going to do that in our trade idea of the day in a sector that's kind of lagging behind, but we need it to take a step forward if this intermediate run is going to really take hold and be maintained. So we'll do that in our trade idea of the day. So let's go ahead and get started. Today is Wednesday, September the 18th, 2019. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 first with the market forecast indicator. So you can see today here, let's zoom in. You can see how we came down and touched that 23% retracement of this near-term run. We didn't quite get all the way down to 38%, and we only touched on an intraday basis. We rallied really nicely off of that into the close today. It brought the near-term line back up above 50, and remember you get below 50, you get a 1 to 3 day pullback that does not drop below 20. That's bullish. Obviously, it's much higher than the last near-term low point in this area here. So that's a positive development. The fact that now we expect now a 7 to 12 day run, you'd like to see the near-term line get into the 80, get into the upper reversal zone. That will help confirm this intermediate rally. But a very, very good sign that at least got above the market sentiment. But now the next stage, get above 80, 7 to 12 days. Kind of that 10-day median would be the nice run, this nice new, and help really establish this intermediate posture. Obviously would probably signify that we're breaking through to new highs. I would venture to guess on this near-term rally would get up at least to slightly higher highs, but all-time highs again, considering that we're pretty much almost there already. We're only 21 points away, and that's less than a 1% off of the all-time highs on the S&P. on the S&P. So, good reaction to the FOMC meeting, even if the market as a whole kind of looked at it as a kind of a hawkish meeting, not as dovish, but the market's looking at a potential soft landing with the interest rates. It's there is some I saw some data that showed when the Fed's first two cuts are only 25 basis points rather than any of them including 50, which is generally the case when the Fed usually is cutting rates because things are getting bad. But that's not the case right now. Things aren't getting bad, and the first couple of cuts have been 25 basis points, and that's a good thing for the markets. And from in terms of what we can expect to see going into next year, that's a good sign in terms of annual returns, 12-month returns going out from here. So nice, good rally here. If you take a look at the Russell 2000, it's a little different story. We did come off the lows on the Russell, but the near-term line did pull back. Again, it had to catch up to the S&P anyway. It ended up being down 0.2%, whereas the S&P was flat. So now the question is it going to regain just like the S&P? Look for that to happen, because the markets can't sustain their bullishness without the Russell 2000 leading. It's obviously not to all-time highs, but if it can get above 1,600, for all intents and purposes, that will be like the all-time highs for the Russell compared to 3,000 for the S&P. Of course, we're well below the highs that we had over here last September before we started that late decline. But for that matter, this year's return, 1,600 has been that key important level. Of course, look at the Dow Jones Industrial Average, looks very similar to the S&P, and you look at the NASDAQ, which also looks similar because that's been a big driver. In fact, the NASDAQ came really close to an oversold cluster here, which would not be a bad thing. The S&P came close to an oversold cluster over here as well, and getting the oversold cluster at the beginning of an intermediate run. Now, we did come close It was actually on this day that we came the closest, and we had a yellow line. That would have been a very, very rare oversold cluster with a yellow line. They usually at least coincide with the first green day. But to get them early in the intermediate cycle is a good suggests that intermediate cycle is going to take hold. Getting them late in the intermediate cycle is a different story. That usually means that we're running out of gas. So we're close on the S&P. We were closer on the NASDAQ, but that would not be a bad thing. In fact, it would be nice if by the end of the week, it kind of would be nice if we got that. If we got a good little move into tomorrow, into the close tomorrow or Friday. You probably will need something like that to get through these highs, like a good solid day with a little bit bigger range than average. And if that ends up producing the cluster, great. That would mean that we're solidified here. Again, getting it late in the cycle is not the greatest thing. Getting it early in the cycle, even though we didn't quite get it over here, but getting it early in the cycle really solidifies the cycle, the intermediate run. All right, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. Click the thumbs up icon down below the video. That lets us know that you want us to keep doing these videos day by day. Comment down below on anything that stood out to you from today's video. Join our daily market outlook email list that we have. There's a link popping up right there in the top right corner of your screen. Click that link to subscribe. Follow me on Twitter for more content in between the videos from day to day. And join our Market Outlook community that we've created on Facebook. Also a reminder to check out the Market Outlook live videos that we do on the days here that I do the Market Outlooks. There's a link in the top right corner that will take you to that part of our website. Again, that's available for all Plus and Premium subscribers. You can get a 30-day trial here to our Plus subscription by clicking on this link above the video. We also invite you to engage with us on social media to ensure that Twitter and Facebook continue to put our content at the top of your timelines. So we try to make that really easy for you to do. Just hit this heart right there that opens up a new window. You can click on like. And then finally, you can click on this image. Opens up your Facebook page, and that will also make sure. Again, Facebook is more notorious than any of them. So to make to make sure that they put our content at the top of your Facebook timeline, just like today's Market Outlook Facebook post, by going through this image here. All right, let's get back to the charts then. Take a look at the long-term chart heading into 2 more days that we have this week. Again, looks like we're going to avoid getting down to today's open, which is at 2950 area. So it's a good sign for the markets there. Now the question is, are we going to get a new higher candle? We don't need it as long as we just avoid the lower shadow, because we are now 3 weeks into this bullish trend that typically lasts, what, 4 to 13 weeks when you're looking at a 1 to 3 month intermediate run. So that's a good sign. We have rising positive momentum. It looks, you can see, we are high. We're not close to the death cross. We had the death cross over here. We had the golden cross earlier in the year. So we're not anywhere near to that. But we also aren't too high to where we can't continue higher. You can see from current levels, we've been more bullish than this for a good chunk of period in all of these trends. So we have the opportunity to expand for the 50-day to pull away from the 200. Just don't expect it to be a significant pulling away because we already are. We're coming up off of a low point that is higher. You can see even we're coming up off a low point that's actually similar to the one that we had here, and that was a pretty decent intermediate rally we had coming from April, March, all the way, with a brief pause in the middle, but all the way into October. So similar low point in terms of long-term momentum that we're coming up off of. If I were to go back a little bit from earlier levels, you can see again about the same level. We came off the same level here in October 14 when the QE3 ran out, and we had a decent run into the end of the year then as well. Some of these others we came off a little bit lower than where we were right now and had some pretty decent rallies. But you can see there's plenty of precedent of coming up off of low points that are already well up above zero. Here's the one that we talked about there, and before moving higher again, and that appears to be what we're doing right now. Let's take a look at the 3 green arrow chart. You can see we obviously have falling momentum. We'll see if that histogram turns back around. See, when you are rising on this bullish trend, we don't always get the histogram to fall below zero. A lot of times it will come towards zero and make small runs. You get the big surge, it starts the intermediate rally, it comes down towards zero and then bounces without necessarily falling all the way through below zero. So that's the kind of expectation we see. Here's the big surge, of course. Now we're falling towards zero. We're getting closer and closer. That just means that we are, the MACD is getting closer to this moving average. It doesn't have to break it necessarily, especially if we don't break the 8-day moving average, which we haven't even done. Even, at the worst today, we were still easily above the 17-day exponential moving average there. Stochastics is below its moving average, but both are just really, really high right now. So that's not necessarily a cause for concern either, in terms of like, oh no, here we are going to pull back now. As long as they're both still in the upper reversal zone, buyers are still in control according to that particular indicator. Let's take a quick look at the Bollinger Bands for SPY. You can see we're kind of running up. So this is the Fibonacci fans of that last intermediate run that we pulled back here. Now we're bouncing back up. We're still kind of working along this 50-day moving average as a resistance. But, again, that's a move up to 313 by October expiration. If we were to maintain that pace, that wouldn't be bad at all. That's not out of the realm of possibility whatsoever. In fact, the options are priced for a little bit bigger move. If we are to move higher, they're priced that we can easily move up to around 313. So keep that in mind. And obviously we are above the point of control. We're outside the value area. Now we're getting more volume below us than we do above us. That's going to make it really easy to lift to the upside here. Let's take a look at the DMI for SPY, and you can see the positive is above 25. The negative's not below 20 yet. So that's a little concern in terms of we really can't get this bullish trend going. You really need to, for us to start grinding, you need to get that orange line below 20, with the blue line above 25, ideally up above 30. That's when you really get going here. So we've been kind of holding on for this Fed. We're not out of the woods here, but it's a good sign on both those levels. And of course, when you go back to like the Ichimoku cloud, we're back up above the cloud. The green line's above the blue line. We're above where we were 26 weeks ago, according to the red line here. All ships, we have a moderately strong bullish trend developing on the daily chart. And then, of course, on the weekly chart, we have a strong trend on the weekly chart here that we maintain, that we've had pretty much since the beginning of the year. Some weakness brought these numbers down, but we still maintain a very strong trend going forward here on the weekly chart. So very easy for us to lift our way up to the upside here. Path of least resistance is to the upside. When you look at the intraday charts, you see how we reacted initially, and that wasn't surprising. The question was, where would we find support? There was support at 298. In fact, I tweeted that out. There was support at 298. If that didn't hold, then we were moving down to 292. I didn't think that was very likely. 295 was probably the area, 296, excuse me, is probably the area where if we pulled back down, we were going to stop, but not very strong support there. So, which means that, a break at 298 meant 292.5 was on the table, and I just didn't think that this meeting would move us that low, and so that made it more unlikely we'd break 298, and it didn't. We held it. We bounced right off of it and got up above where we were trading pre-FOMC and broke through the last couple of days of really tight ranges. Again, more volume to the downside than we have to the upside now makes it much, much easier to get a move on here. If you look at the today's trading range and the volume picked up. It was 73 million. The trading range almost got to average, right? But that's okay. We don't want it to be too big. To put those numbers into context, you can see the volume here at 73 million, not too high, and the average trading range here at 3 points. So they turned up a little bit, but you see how now the ATR is getting closer to crossing below 1%. That's the mark where, okay, this trend, according to this indicator, that's the mark that would suggest we are now entrenched in this grind higher to the upside. And finally, looking at the VIX, look at that big breakdown. So we had a move up in volatility here immediately after the FOMC, right into it, and then immediately afterwards, and then since then, big time drop on volatility down to 14, closing at the end of the day, closing for the second time at low levels here, lower than we have all this go around, right? These two daily closes and what really would be a weekly close, depending upon where we finish here, would be the lowest relative to its back month ratio, 3-month ratio that we had in a while. So you can see there was a few times back here we closed a week at 80%. So, and that prompted a jump in volatility both times. So keep that in mind, that if we close here Thursday and Friday, that could prompt, maybe not necessarily immediately, but that could prompt a little bit of a jump in volatility on the next near-term pullback. So we'll keep our eyes here on the volatility index. But the nice thing is, we are firmly entrenched in the bullish territory, and the more we trade in the lower half, the more we can sustain this slow grind higher. All right, so before we look at some other, like what's driving the price action and our trade idea of the day, or just to summarize our technical outlook, we are now, we're getting more and more signs that this intermediate run is going. We had the near-term pullback after the initial surge. We are bouncing back up in the near-term line. The Russell's maybe a day late, so you'd like to see the Russell kind of confirm. It was weaker today. We don't want to see it continue to be weaker. That's not a good sign. That might mean that we get a shorter intermediate run. But if we want to get a good long intermediate run, we want to see that Russell 2000 participate, catch back up again, like we did last week, catch up again by the end of this week, and lead the way forward here, at least at the beginning of this intermediate run, to make sure we get a multi-month, which is kind of what we're expecting going into the end of the year. So good signs. It will be a grind. It will be slow, small moves to the upside, especially as we get back to all-time highs. And it might be boring, but that's what happens. That's the kind of moves you get when you are grinding your way through an intermediate run, getting all-time highs every new higher close. So that's the mode that we're in right now. We've made it through the big risk event of the week, barring a trade-related tweet. There's generally speaking, and I'll talk more about that here in a second, but barring a trade-related tweet here, we are all systems go on this bullish intermediate run, according to the charts at least. So what do you think? Do you agree with that assessment? Disagree? There's a link popping out right there. It opens up a poll, then hit either agree or disagree. Of course, if you hit disagree, comment down below on anything you're seeing that suggests otherwise, right? Whether or not you're not so confident in this bullish pattern, or you might actually be more bearish right now coming out of this meeting. Share what you're seeing that drives that opinion down below. All right, now let's take a look at what's driving the price action here today. And you can see here's a chart of the different asset classes and how they've been performing, how they've performed going into the, pretty much since the end of the week. And of course, crude oil starting off the week with a 14% gain at the high on Monday, obviously is down to now only a 5.75% gain. Not too often you see crude oil and long-term bonds rallying, but long-term bonds held a lot of their gains, even if the S&P 500 rallied to break even. The rest of the markets, they were down, but they all kind of pulled back up here. Let's now transition to just today and how they performed just today. You can see long-term bonds were up going into the meeting. Here's the break of the meeting. Gold dropping, the dollar rising, long-term bonds and gold both dropping. Those are your safe haven assets that were so bullish for so long, both of them dropping as sharply as they did. You can see high yield and pretty much all your risk asset classes all dropped initially as well, in addition to gold and bonds, and you had a dollar rally. But then, of course, by the end of the day, the dollar held its gains. The bonds pretty much was flat. Gold rallied a little bit, along with emerging markets, small cap stocks, crude oil to some extent. S&P 500 rallied sharply. coming off of these lows here at 1240. Coincidentally, it was right around this mark in the press conference where Chairman Powell mentioned that they would start another round of QE again, potentially sooner than what they had thought previously. So that's an element that the market's like, well, hey, the last time we had QE, that was like 2013 into 2014. The market took off like a rocket during that period of time. So the market would more than welcome that round, and so stocks rallied coming off of that comment into the close. So that's how the different markets reacted. Of course, by the end of the day, you can see bonds and long-term bonds and the dollar, preferred stocks, investment grade. I mean, that's not really risk on. You do have the VIX down here at the bottom. You have commodity, with the gold. So there's some element of risk off down here. But you also see crude oil and emerging markets and small caps at the bottom too. So by the end of the day, it looked more like a risk off day than a risk on day, with what ended up at the top and what ended up at the bottom. Now the question is, what's tomorrow going to look like? And if things take off again, you want to see small caps up here at the top, along with all the other equity asset classes and commodities. That's your risk on element, and that's what you'd like to see again lead us through going forward from here. Of course, the big news was the rate cut, and now the expectation is what's going to happen going forward. And you can see here's there's a 38% chance, roughly 40% chance that we won't get a rate cut by the end of the year, which means we got about a 60% chance that we'll get one more. Those are high probability odds, not baked in the cake, right? That's when you get to 80%, that's when it's pretty baked in. You can see October, there's a better chance of not getting a cut. So it looks more and more likely that we'll take October off and then check again in December for what the Fed may do at their next meeting. That's more in line, again, the Chairman Powell has alluded to the mid-90s, and while 98 was 3 back-to-back cuts, 95 wasn't. 95, there was about a 6-month difference, or about 5 months difference between the cuts. The first and second cut, at least, and before we had a back-to-back cut to finish it. Both of them ended up with 3 cuts. So that's looking more like, at least what some of the market is saying, especially if you go out to next April. Now here, so we are 2 cuts. We have an 85% chance of getting a third cut, one more cut going into next year. And then after that, you can see you have about that's 50% right there. So it's a 50-50 odds that you get a fourth cut by next April. So it's a coin flip at that point. So it's there. It's on the table. It's considered, but it's not baked in the cake. It's not even a high probability. It's just basically a coin flip, and obviously no odds at all that we would raise rates by next April. So the Fed, the market's increasingly pricing in the odds that we're kind of done here. Now in the past, what's that done for the yield is, here, let's first take a look at the daily chart for the yield. In the past, when the Fed's had those short rate cuts, it's usually been a positive for yields, and yields ended up pulling down by the end of the day, by the time all is said and done. But it is on a bullish pattern, right? You got the long dark green shading, the green line. We've broken through. We've pulling back now. The near-term line has pulled back. Expect to see yields bounce off of there here and make a run back up to the upside from a now this isn't 10-year note, but from a long-term perspective, you can see you probably have a little bit more room to fall here on TLT down towards this 132, 133 area, 132 and a half is where you'll find a significant area of support. We probably don't want it to fall below that. If you fall below that, now we're looking at 120, and that means we're getting a big jump in yields. And that won't necessarily be healthy either, to get a big jump in yields. So we'll keep our eyes on that and look for it to support. But I wouldn't be surprised in this next intermediate run that we don't pull back down into this area and kind of hold some support around by November expiration, and see what happens from there. again, that's kind of the expectation is we'll be bullish in equities into the end of the year, which would by then would be in this area, the end of 2019, which is the seasonal trend for stocks. If you take a look at the seasonality for TLT, and here let's do price as percentage. You can see we are in a seasonally bearish trend for TLT until about that November expiration. So look for it to come down to about that 132.5 area, and then into the end of the year actually rally. That's kind of your normal seasonal trend for over at least the last 5 years for TLT. If I were to go back a little bit further, you can see it's about the same trend, and right now we just happen to be in a bearish frame. Interestingly enough, here from May up to October is typically a bullish. To the beginning of October is typically a bullish run for TLT, and boy, howdy did we have a bullish move in equities, pretty much going from break even for the year all the way up to about 20% gains for the year, which is way out of the ordinary. The average is to get about a 3% return. So don't be surprised if we don't get as big. Again, a move back down to this area, which is where that 132 is. By November expiration would be back to only about a 7% gain, which would still be very high, especially for the time of year, because the time of year we're back to break even for the year on TLT. So that would still be a really decent return for the end of the year. And of course, looking at SPX, by the time here we got, there might be a little bit of weakness from a seasonal trend, but I don't even really anticipate that. The Fed meeting could have sparked that, but obviously now of course a trade tweak could spark that too. But then you see the seasonal trend for equities in the last 20 years is to rally from here. And again, we are already at a 20% year-to-date return going forward from here. So we're not going. I don't expect us to have a big move to the upside. Once we clear, it's going to be a grind. It's going to be a slow grind. Volatility is already low. ATR is already low. The volumes are already low, average volumes. So it will seem like the market's not doing anything, and it will seem like it's not very bullish, but that's just the reality. And we're already up 20% year to date, and that's well above the norms for this time of year. So even though the seasonal trends say go forward up from here, expect it to be a lot more of a grind than we saw here, and especially, even over like in this area where we were grinding to a halt here in July. All right, so now let's take a look at how the sectors have been performing, and we saw that we've seen that we have our biggest losers are the ones that have gained the most. Again, from that August 23rd low point. Here, let's go to August the 23rd. From that August 23rd low point till now, and let's go about like 30 minutes. Those were our biggest winners. The energy sector, the financial sector, the industrial sector, all your biggest losers were your biggest winners. That's very, very typical. Originally, if you notice here, initially it was real estate, your momentum at that time, your real estate, staples, and utilities, and that's not what you want to lead. So it's a good thing that we did get a change in leadership here on this run, but the problem is now again, that's not your typical leadership that you want to sustain going forward from here. So now what we would like to see is from here it would be the 918. If I were to go to 918, well, that was today. Would that be today? Oh, that's in the middle today, so I can't quite get to that point. But we would like to see now, here, let's just go to 918, just look at today. 918, there we go. And go to a 10-minute chart. You can see utilities and financials. Interestingly enough, those are your two biggest winners. Those are not typical bedfellows here. They're usually on the opposite ends of interest rate sensitivity. So it's interesting to see those two. And utilities are obviously leading the way higher, along with gold, which is kind of linked to materials and staples, healthcare too. But again, going forward from here, we want to see technology. We want to see Not so much staples and materials, but you want to see technology, you want to see discretionary and communication services lead. And you can see technology at the worst of the day today was the lowest, and it jumped and it went past the black line. Communication services was well down here too. It rallied up and almost passed everybody else. And then consumer discretionary also was well below some of these areas, and it's jumped and it maintained its lead over like industrials, and really for that matter probably financials and utilities too. So that's the leadership you'd like to see, and as long as they start to continue to work their way towards the top of like Brandon's sector selector rankings. So here's the current rankings that he has. Of course, industrial is getting the overbought cluster here last week, and you can see some of these closer than others. Real estate and staples also getting the overbought cluster, and you can see down here at the bottom, energy, materials, dollar-sensitive areas, really kind of energy blowing up here, industrials blowing up here and catching up in a big way to some of these other areas, and then financials, the other big loser. That has been catching up in a big way to the S&P 500 as a whole. Technology now kind of lagging. You can see it's down here to communication services down here at the bottom as well. Discretionary trying to make a run back up closer to its 3-month highs. So those are the areas we want to see kind of lead us up, and not necessarily, especially not the safe haven areas, and not necessarily industrials, financials, and energy either. I mean, they can outperform, but you don't want them to necessarily be the leaders because it's hard to sustain a good intermediate rally if they are. They tend to be smaller segments of the S&P 500 than some of these bigger segments that are bigger stocks that are in discretionary, Amazon, and communication services with those FANG stocks, and then technology with Microsoft in it and Apple. All right, so that's one area in the technology sector that's actually doing pretty well and holding up compared to other industries in the sector is semiconductors. And one of the stocks in there, Applied Materials, you can see it's got a very high probability setup. It's not quite at all-time highs. We closed at 52.14 over here. We closed today at 52.09, but it's got a new intermediate run going. The near-term line bounced back up. We got a dark green shading, green line rising. The momentum or market sentiment's rising up above 50. So you got a bullish pattern here. You've got 3 green arrows for the stock. You can see it's the momentum. The MACD histogram is pulled down, bouncing up a little bit here today with a little bit of a bump in volume above average, appearing like we are bouncing off of the 8-day moving average here and continuing to trend high. We're already so bullish, and you can see from a long-term momentum standpoint, we've already established some really strong momentum to get to this point. We've been more bullish than this before during this 16-17 run. So we've got some strong momentum going. If you look at the Bollinger Bands, we've cleared the value area. We're bouncing off of this little volume node, and then if you look at its DMI, you can see that it's negative. We're above 30 on the positive, and now we're back below 20 here on the negative. We got this rising ADX above 20, so we got a good trend developing and moving here. But considering we have the high probability set up already, and not necessarily too speculative here, then that bodes well for a high probability strategy, and that leads us to selling a put vertical spread on this, selling right around that 30 delta. In this case, selling the 50, buying the 48. We're already down. When we got into this, typically like to get about 47-cent credit to get a 30% return on risk. We got close to that. In fact, as I was preparing for the live video, we were there. And then by the time the trade went through on the live video, we got about 46 cents. And you can see by the close, we're a few pennies off of that. So if it continues to make a good run to the upside, then great. We'll take we'll take half the gain, 50% of the gains. If we can get it quick, we'll take it and move on to something else. Otherwise, if it grinds, great. As long as it stays above 50, we'll let it grind, do whatever it wants. If it pulls back tomorrow and we can get closer to 47 cents, then that will open up the opportunity for anybody who didn't get in before the close to get in tomorrow or any day after. Again, high probability technical setup because it decreases the reward risk potential on a directional speculative trade, so it leads to a high probability strategy, and that's what we do here. And we can, because earnings is post October expiration. You don't really see that here, but you can see it in this one. Because it's post expiration, you can put on a normal position size here to account for that earnings risk, but that we don't have to account for the earnings risk in this case. So you can put on a normal position size, and if it breaks 50 for whatever reason, and we break that volume node and we work our way back down to 47, then we'll take a small loss on this trade and look for a different setup. So that's our trade idea of the day. All right, and that wraps us up for today. You've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen to go to our Market Outlook forums on marketscholars.com. Of course, you can be any level subscriber, including the basic level, the free level, to participate in our forums. So if you have any questions or comments about today's video, open up a new thread there, reply to anybody else's thread, and let's keep this conversation going regarding this market outlook from a technical as well as a kind of macro fundamental perspective. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video down below. Follow me on Twitter for more content in between these videos, and join our community at marketscholars.com, as well as the community we've created on Facebook. Have a great rest of your evening, everybody, and we'll see you all next time.